it was your research that's the whole reason we talk about inverted yield curves, because you were the first,
I can't believe we're still talking about my dissertation from 1986.
We really have you to blame.
I just want to
a lot of journalists employed.
Track record.
It's like, so, obviously 30 years ago, you observed this phenomenon of inverted yield curves preceding recessions. We've had some curves still in inversion, 3-month, 10-year, 210 is positive. When you look at the sort of the structure of the curve right now, how serious of a warning do you see for the economy, even ignoring the data that we're getting?
Yeah, so importantly, my dissertation, 1986, looked at the 10-year minus 3-month.
Okay,
so
which
that
is still
inverted for a
today.
quarter, June 30th. So we're looking at 2 quarters of inversion.
Yeah.
At the time of my dissertation, I had a 4-for-4 record, and people are pretty skeptical because only 4 observations. Right. And then afterwards, to my surprise, I had inversions before the next 3 recessions and no false signals. So that's important. 7 for 7, no false signals, and now we're code red. We have an inversion effectively for 2 quarters. It's really hard to ignore.
All right, well, code red, I mean, some would argue that it's a little bit more of a code yellow or like a magenta or something. I mean, at this stage, I mean, does it really have to be a signal of a recession itself? Can it not just be a signal of slower growth, or at least of some sort of growth level that people can sort of wrap their heads around?
Okay, excellent point.
Okay,
so
do I get to be on your next dissertation?
Yes, you are like one of my committee members. My model, so it's not just an empirical observation. There's economic foundation in the theory behind it, that the slope of the yield curve is linked to future economic growth. So obviously, low growth is often associated with recession. So empirically, this model is 7 for 7 in terms of predicting recessions. But if we dodge a recession, if we have a soft landing, and let's say growth slows to 1%, then the model has given an accurate signal. So whether we're inverted or flat, it doesn't matter. It suggests slower growth, and importantly, it's not the only indicator that's suggesting slower growth.
Yeah, there's some data to back it up as well. Sarah, it's interesting that we started to have in particularly the Market Live blogs, some of the suggestions here, Commerzbank analysts writing up something called stall speed. And to that end, whether or not it's a recession, there's certainly some sort of suggestion that we're hitting, if we get to just 2% growth, we could then suddenly nosedive in some way. And they're worried that the US, therefore, isn't the haven we all thought it would be within a global slowdown. Is that what's freaking investors out as well?
Right, and they were pointing to the dollar turning lower as well instead of moving higher, because through all of this, the concerns have really been about global growth feeding over into the U.S. And you hadn't seen too many cracks in the foundation here in the U.S. But now, after this ISM number, you look at the ADP employment numbers, they did miss. If you look at the 5-month average, though, it's now at the lowest since 2010. So you're now starting to see cracks in the foundation stateside in the United States. So some people are starting to ask the question, is the U.S. actually the safe haven that we've thought it was all along, as we've been talking about global recession fears or a global growth slowdown? Can that actually feed over into the U.S., or are we already seeing it start to emanate already here within the States?
Cam, the naysayers say things like, oh, it's different this time because QE has suppressed long-end rates, or rates are so low globally that everyone around the world is buying U.S. treasuries to find a little bit of yield. Is this all familiar to you, like the last 3 times post your dissertation that we had inversions? Were there people all those times saying, oh, yeah, there's other factors and this time it doesn't work?
Yeah, I hear this all the time. Look, every time is different. So that's a trivial statement to actually make.
Yeah.
So the question is it different enough that it renders the signal a false signal? Okay? And I don't think that it is that different. So the QE, the Fed had way more influence over the curve in 1960s and 70s. The size of the bond market today is so dramatically larger, it's harder for them to mess it up. And on top of that, it's conveniently omitted in the discussion that the Fed's balance sheet has been decreasing in size since 2017. And that should actually lead to a steepening of the yield curve. So given that we've got the Fed balance sheet decreasing in size, given that we've got the yield curve inversion, it's even more powerful to me that this is probably a true signal rather than a false one.
So another argument a lot of folks will make, though, too, is that once these signals do appear, there's still a pretty long lag time between you get to a recession or even to a real market
That's
downturn.
a good thing.
And a lot of folks say, hey, this is actually the time where you want to be invested, assuming you were already there, ride it out, and then at some point, I guess if you're crazy enough to be a market timer, you jump off the ship at the last minute.
Yeah, so this is really interesting. This time is different in the following respect. That in 2006, when the yield curve inverted, nobody took it seriously. But after the global financial crisis, people saw, oh, well, this indicator is 7%. So it's getting much more attention today. And I think that if we go into a recession next year, it's not going to be a surprise. It was a surprise in the Great Recession. And you know what happens in a surprise? There's slashing of employment, and it makes things worse. Given that we have these indicators well in advance, that lead time is very helpful, that people can plan. They can do risk management. We're not going to bet the company on some extra debt for a new project. Consumers can be more cautious because all of these signals are suggesting heightened risk. So I think all of this could mitigate the severity. If we have a recession, it could be very shallow, and ideally, we avoid a recession, have slower growth, and a so-called soft landing.
But Cam, do you worry that your dissertation all those years ago has deemed us into a situation of a self-fulfilling prophecy, that actually the yield curve inversion means we get a recession?
Yes, so that's it. So my model in my dissertation, very simple. There's no Federal Reserve even in the model, and it's not a causal model, but this idea of all of the publicity that the yield curve gets turns it into a self-fulfilling prophecy. And what I'm arguing is that's a good thing. It actually helps corporations plan. Why wouldn't you use information that's relevant about future economic growth in your planning? So given that we've got the ability to do higher quality forecasting of what's going to happen in the economy, this helps firms plan, and you don't get the surprise, and you can mitigate the severity of a recession if it occurs, or maybe dodge it.